here is exercise 9. So it says in exercise 9 says refer to information in exercise 8, which we did last week. And for each of the adjustments in exercise 8, indicate by how much net income in the income statement is higher or lower if the adjustment is not recorded. So let me get back to that exercise 8 for a second. For exercise 8, we did 3 adjustments at the end of the period, which is the recognition of depreciation expense, recognition of interest income, accrued interest income, and recognition of some revenues that we earned, and we need to recognize it. So we reduce the liability, deferred revenue or unearned revenue. We reduced it by doing debit, and we recognize the revenue instead. So if you don't do these 3 in exercise 9, says what's going to happen. So if you don't do number 1, your expense, that expense, depreciation expense, will be understated by $7,000. If expense is understated, then net income will be overstated by $7,000. If you don't recognize the adjustments number 2, the interest income, then your income will be understated by $1,750. Therefore, your net income will be understated by $1,750. If you don't do number 3, recognition of revenue, your revenue will be understated by $4,000. That means your net income will be understated by $4,000. If you don't do any of those 3, then overall, your net income will be overstated by $1,250. If net income is overstated, then your retained earning eventually will be overstated. Make sense? Your retained earning will be eventually overstated. And if you don't recognize this interest receivable, then your asset in your balance sheet will be understated. You will have less asset. If you don't record number 3, deferred revenue, the liability will be overstated in your balance sheet. Liability will be overstated by $4,000 in the balance sheet. So bottom line, and this one, if you don't record this number 1, accumulated depreciation, so your balance sheet will be also overstated by $7,000 for net fixed asset. So your net fixed asset for equipment, let's say, will be overstated. So you will have higher asset balance. So as you see, if you don't do your adjusting entry, you're gonna have an issue with your income statement, and you're gonna have an issue with your balance sheet. So technically, your whole financial statements will be useless. Okay, so let's do one more since we are reviewing. And that is also part of your homework, number 10. Okay, number 10. Here is the question. Consider the following situation for Shocker. On November 8th and on November 28th of 2021, Shocker receives $4,500 payment from a customer for services to be rendered evenly over the next 3 months. That means $1,500 a month, right? Deferred revenue is credited. So when you recognize this, you debited the cash because you received $4,500, and you credited unearned revenue or so-called deferred revenue. right? So now you have a deferred revenue. But that was in November. So December, as soon as 1 month is gone, you need to recognize that 1 month of service has been provided and you need to recognize the revenue for it. So there is an adjustment necessary for this. Let's do one by one. So here we go. So you have to recognize that the liability should be reduced by 1,500. Normal balance for any liability is credit. So if you debit it, liability will be reduced. And you recognize revenue, credit 1,500. Normal balance for any revenue is credit. And if you credit revenue, the revenue will increase. So there you go. So liability is going down and revenue is going up. Any question on number one, please?
Professor, I have a question.
Mhm.
So in regards to the deferred revenue, we wouldn't start at 4,500 for the debit and then proceed with the credit of 1,500, right? You would start with whatever's being debited first. Is that what it is? Because I know you were receiving.
Let me show you a T account. So let me get a paper.
Okay.
And okay, this stuff was last time. Okay. So let me get a paper. And everything we do or I want to do, and I would like to understand it, and I like to make no mistake whatsoever, because remember, accountant, they can't make mistakes. So you have. So I like to kind of see the picture. And I say, okay, this guy is giving me $4,500. So that means I have a lot of cash here, but this guy is giving me $4,500. That's a cash, that's a debit. However, because it's not earned, I'm gonna put it in unearned revenue or deferred revenue, whatever you call it. And that's a credit. So by doing that, your liability is going up and your asset is going up. But at the end of the year, after 1 month, on December 31st, a month of this service, this is 3 months of service. So 1 month of this service is recognized, should be recognized. So here I have the revenue, and I would like to recognize 1 month of this. So 4,500 divided by 3 months is $1,500 a month. So I'm going to reduce this unearned revenue here. That's number one, adjusting number one. And I'm going to recognize revenue of $1,500. That's adjustment number one. Okay, now ask me your question.
So where would there be a place to put like the remainder of the credit that's left behind?
Credit of what? Which account?
Okay, so for example, you received $4,500 cash for a service up front, and then for the deferred revenue, you placed that $4,500 for a future service. Then $1,500 is going to be moved to revenue for the following month. But is there under 4,500 where it's deferred? Do we put 3,500? Or I'm sorry, is it 3,500 or 3,000? 3,000.
Yeah.
Yeah. So okay, just is that the way you're supposed to do it to keep track?
Yeah.
Okay.
As an accountant, or business owner, you need to understand at any given moment how much revenue you have, how much liability you have, how much cash you have, who owes you how much you owe to who, what company. So you are the smartest guy in the company because you know every single information. In the company, whoever wants to know something, you are the only guy that they come to you and ask questions because you are the smartest one. You know all the numbers, you know all the details. Not memorizing it. I'm not saying you're gonna memorize it, but you're gonna pull it up pull it out of your data and provide the information. So as soon as someone, let's say my manager said, by the way, how much deferred revenue do we have as of end of this year? And I'm gonna look at the, let's say, deferred revenue here, and I'm gonna say we have $30,000 of deferred revenue, which we're gonna provide this for this company for the next 2 upcoming months in January and February.
Okay, understood. Thank you.
Yeah, so your job is to be the most organized, most informative person in the company. That's why it's very hard to find, good accountants, because accountant needs to be very organized. And most students, let's say you ask them, what's your major? They say business, but then they say, why not accounting? Obviously, they don't like it because it needs a lot of attention to everything, to provide all the data, financial statements. Accountant, normally they cannot make a mistake. A manager in a business makes mistakes almost daily basis and makes wrong decisions. And most of the times it will be costly. But an accountant cannot make a mistake, because the moment you make a mistake, you're gonna mess up the whole financial statements. So everything you do will be just junk in 1 second. So you cannot make a mistake. Everyone can make a mistake, but not you. So you have to be organized. You have to have, as soon as you are telling me this stuff, even if I am explaining it verbally, you need to have a paper next to you. And immediately I say, you have to write a T account, put $1,500 here, write a T account, deferred revenue, put $4,500 here. So as I am talking, you need to put all this stuff in the T account so you can visually confirm all the information that I'm talking about on the T account. Like if I remove PIN, share my screen, if I show you this stuff right here doesn't provide you any information because it's just a journal entry.
Right.
This journal entry will make sense as soon as you put it in the T account, as soon as you post it to the T account. So the moment I am showing this, I read the problem and then I'm showing this, you have to say, okay, let me look at my T account, because you are already posting it to T account so you can see exactly what's going on. Other than that, by just looking at this, it will not provide you visual information.
And then, Professor, regarding the question, back to that same question for exercise 10, number 1, the reason why you put 1,500 is because they're asking you to, I don't see the question anymore. That's why I just wanted to make sure where it says it on there. So it's 4,500 customer service next 3 months. So it's basically telling you to put what it would be for the next 3 months. Deferred revenue is okay, so that's why you put 1,500. Got it.
And who knows that? In the whole company, from first floor to 10th floor, no one knows that exactly. You are the only person who knows this $4,500 is supposed to be for a service that will be rendered during the next 3 months. Everyone else will forget that in a matter of 10 seconds. You cannot forget that. You need to definitely have a very good record keeping of what's going on. So let's say, for example, Costco. Everyone is paying Costco for a membership annual basis. But moment that you're paying, let's say $120 to Costco for annual basis for a membership, Costco is not recording that $120 membership fee as revenue. They will put it as deferred revenue, membership revenue. So that's a deferral. And then every month, let's say month of January is finished, 1 month gone, the accountant in Costco will recognize $10 of membership revenue. Another month, February, the accountant will recognize another $10 of revenue. So by end of the year, the whole $120 that you gave to Costco will be recognized as revenue as we go forward.
Okay. And then for the dates, would you indicate right next to it in parentheses, like January, February, or would you just start a new T account and put the date on the top for each one?
Okay, those T accounts that I'm showing you, those are just for class purposes.
Okay.
Let me stop sharing for a second and turn on my camera again.
Yeah, like for example, in this example, there's 3 months of it, right? So
Yeah,
how would you display 3 months on there?
This is a so-called an account, not that one in a real life. So here is saying date. Here is saying account. Here is saying debit. Here is saying credit. Here is saying balance. Debit, credit. So here you put a date. You say, for example, November 28, 22. That's the date. And then in this date, you recognize that one, a credit, 4,500. And imagine this, what account is this? This is deferred revenue, right? So that's the name. And even account number is in here. Account number is right there in the account. Account number is, this is a liability, starts with 2, let's say 220, 220, for example. So every information in this T account looks like this actually. And then you credit 4,500, then what is your balance? 4,500. And then you do the adjustments. As soon as you do adjustments, this T account looks actually like this. So you do an adjustment. The adjustment is 12/31/2022, right? And your account is deferred revenue. And here is credit of 1,500, let's say. And now your balance will be what? 4,500. That's a credit, minus debit of 1,500 plus 0 credit, enter. And the Excel or your software will show here 45 minus 15 minus 0, that's 3,000 right there.
Okay.
But that's how the T account looks like. But in a classroom format, I use this because it's easier to show. I don't have time to draw a very sophisticated T account like that. Sharing my screen again. Okay, so the next one says on December 1st of 2021, the company pays a local radio station $2,700 for 30 radio ads that were to be aired. 10 per month. Okay, 10 per month. So, so 2,700 divided by 3, right? 10 per month. Throughout December, January, and February, prepaid advertising is debited. So what is the journal entry here? Let me, 2,700, don't forget that. And let me show you my adjustments. But before we go to adjustments, let's look at the journal entry on the camera. So stop sharing, pin. Okay, so what happens is we paid $2,700, that's cash credit. And we recognized prepaid advertisement for 2,700. So prepaid advertisement, $2,700 asset recorded, cash has been credited. And at the end of December, we know 1/3 of this advertisement has been performed, and we have the obligation to recognize the expense at that point at the end of the year. So we recognize advertisement expense for 27 divided by 3 is 900, I believe. So advertisement expense is 900, and prepaid advertisement will be reduced by 900. So prepaid advertisement as a form of asset now is only $1,800 balance, and we have advertisement expense. And that's how you do the journal entry. So if I share the journal entry now here, it makes more sense. Here we go. So advertisement expense, debit 900 to recognize it as a form of expense, and reduce prepaid advertising by 900. Okay. Next one. Okay. Next one, number 3. Employee salaries for the month of December totaling $8,000 will be paid sometime in January. So again, anything happens in 2021, let's say, has to be recognized in 2021. So for $8,000 of salary expense, we didn't pay yet, but we need to recognize the expense. So here what you do, so you debit salaries expense to recognize it because it has been accrued. And this is accrual adjustment. Accrual adjustment means there was no paid or received cash, but just something accrued because of, let's say, passage of time. So these first two are deferral adjustments because you deferred the recognition of revenue or expense. Now you are recognizing at the end of the year. But this one is accrual adjustment because nothing paid or received, but just something accrued because of passage of time. So here is salaries expense accrued for $8,000. But since we didn't pay, we say salaries payable. The last one, it says on August 31st of 2021, the company borrows $70,000 from a local bank. A note is signed with the principal and 9% interest to be paid on August 31st, 2022. So what was the journal entry on this date? It was borrowing, so cash was debited for $70,000, and note payable was credited for $70,000. It's payable next year, 12 months later, but you need to recognize adjusting entry for what? For the interest that has been accrued, even though you're not going to pay yet, but whatever, it's accrued interest. So this is an accrual of interest because of passage of time. So it's an accrual adjustment. Okay, so accrual adjustments of how much? Here we go. So $70,000 times 9% times 4 months out of 12 months that has been passed. So therefore, it will be $2,100 interest expense debit.
Professor, really quick offhand, do you know why there's 4 months?
I don't know. Let's read the question again. So it says August 31st. So if it says August 31st, that means August is not included. So we have September, October, November, December. 4 months. September, October, November, December.
On August 31st, Shocker borrows $30,000 from local banks. But isn't it 12 months?
12 months will be, yes, one time in future will be eventually 12 months. But we borrowed in August of 2021, and today is December 31st of 2021.
Oh, I see. Okay, so 4 months of the, okay. of the 12. Okay.
Yeah. So that's a good question, actually. So let me show you on papers so you can see kind of.
Yeah, the dates caught me off guard, I guess, because of the scenario that we
But
were.
again, let's do that also see what's gonna happen in August of 2022. So I'm gonna turn the camera, stop sharing, pin my video for you. Okay, so first of all, remember you borrow $70,000, so debit cash. That was August 31st of 2021. You borrowed $70,000 cash, and here we go, you have note payable of $70,000. So far, so good? That's August 31st. Now, we are in, let's say, December 31st. So in December 31st, you're gonna say 4 months is gone. I have interest expense for 4 months. How much was that? I forgot. Let's see. Interest expense for 4 months was $70,000 times 9% times 4 out of 12. That's $2,100. Okay, so $2,100.
Wait, Professor, how did you get 2,100 again? Sorry.
2,100. This is how you calculate. $70,000 borrowing times 9% times 4 months out of 12 months.
Oh, okay.
Use your calculator to calculate that. So that's how you know how much your interest has been accrued. So you recognize the accrued interest expense of 2,100, that's a debit. And then you say interest payable because you're not paying right now. And that's $2,100 credit liability. So expense, normal balance debit will increase, and liability, normal balance credit will increase. But now let's say, just give you a little bit more information. Let's say it's August of 2022. August 31st of 2022, you have to pay it back, right? So how do you pay this back? So just show you the journal entry. The journal entry would be first closing the note payable of $70,000. So that's a debit. And then you have to pay cash. How much? We don't know. You have to calculate it. So you have to say $70,000 times 9%. And that would be $70,000 times 0.09.
$6,300.
$6,300. So that's your interest. Okay, so you're gonna pay $76,300 back. That's your cash credit. But you have a interest payable here that you already recognized it. So you need to close that. So interest payable will be closed for that payment of that loan. And that's $2,100. You need to do debit, right, to close it. So that's a debit. The remainder, that's the interest expense, which will be $2,100 minus $6,300. 6,300 minus 2,100. That's for 8 months of interest, which is $4,200. So that way, you on August of 22, you close the loan. including payment of interest. So the liability is closed, interest expense is recognized, and you pay $76,300. And the note payable is closed. So then you post this into journal entry here. So note payable should be closed right there. So that's 0. Interest payable should be closed. That's 0. You recognize this is already closed at the end of the year. Remember, every expense or revenue is closed. That's a closing entry for temporary accounts. So you recognize another $4,200 of interest expense for year 2022. And you pay $76,300 cash to pay that liability. Questions? Again, for closing entries, I have the video for accounting cycle 4-part. So if you watch that accounting cycle 4-part, you will see the closing entries that I am closing. Those temporary accounts, which is revenue is a temporary account, needs to be closed. All expenses are temporary accounts, needs to be closed. And also dividend needs to be closed. In your problem, if I look at one of the closing entries, after after you prepare your financial statements, you need to close those temporary accounts. So I'm looking at a problem that has a closing entry, so I can show you a sample of it. Here, record closing entries here. So that's problem number 17, which is part of your homework also. So here in 17 says the company's fiscal year end is December 31st of 2021. The following is a partial adjusted trial balance of December 31st, as you see here, and says, okay, we prepared the financial statements, everything is done. All you need to do is just close the temporary accounts and have post-closing trial balance ready for next year to start fresh. So prepare necessary closing entries, calculate ending balance of retained earning. So retained earning, as you see previously, you had a $30,000 balance. But what is temporary here? Dividend is temporary, needs to be closed. Revenue is temporary, needs to be closed. Interest revenue is temporary, needs to be closed. And all these expenses are temporary, needs to be closed. Okay, so how do we close? In my 4-part accounting cycle, I did the original standard version of closing. So if you watch my 4-part accounting cycle, probably part 4, you will see how I am closing over there. But your book is showing a little bit shortcut in regards to closing, which that's okay. That's one way to do it. I did the original standard closing, so you understand maybe better. But your book is doing a shortcut. So here is your book version of the closing entries. That was problem 17. So what you need to close, first thing, you are closing your revenues, and then you close your expenses, and then you close dividend. So in my method that I was teaching in the video, I said close your revenues into income summary T account, and then close your expenses into income summary, and then finally close the income summary in the retained earning. However, your book says, let's not use income summary. Let's directly, since income summary gonna be closed into retained earning anyway, so why not close the revenue and expense directly into retained earning from the first moment? Okay, that's a shortcut. So here, service revenue is a normal balance of credit. We close it as a debit to close it. Interest revenue is normal balance elegant credit. We do debit to close it. And instead of closing into income summary temporary T account, we just don't use income summary and we put it directly into retained earning. Why? because again, your book says, since from income summary, eventually you're gonna put it in the retained earning, that's extra journal entry. So let's skip that extra journal entry. That's fine. So put it in the retained earning directly. That's fine. Any question on how to close revenues? Okay. The next thing, you close all your expenses. Expenses, they have normal balance of debit. Obviously, you do the other one, which is credit in this point. Credit all your expenses first, add them up, and enter it as a debit here at the top into retained earning. So far, so good. All expenses and revenues are closed. Post them into the T account. Obviously, every journal entry needs to be posted. And then retained earning, the last thing you need to close is dividend into retained earning. So close the dividend into retained earning. This part, closing dividend into retained earning, either in my video or in your book, is the exact same thing. The only thing is different in my video with your book is in my video, I'm using income summary to close revenue and expenses, and then close income summary into retained earning. Your book says, no, let's close it directly into retained earning from day one, which is fine. But closing dividend, either in my video or in your book, is the same thing. So dividend has a normal balance of debit, credit your dividend, and debit retained earning. Now, what happens in your retained earning? As you know, the beginning was $30,000, right? But you close your revenues into retained earnings, so your retained earning will go up. But then you close your expenses into retained earning, $40,000, so your retained earning goes down. And you close your dividend into your retained earning again, so your retained earnings, leftover profit, goes down again. So your leftover profit that you don't know what to do with it right now, and you might use it in future to maybe pay more dividend or buy new equipment or anything in future, that's $43,000 remaining profit, retained earnings. And you moved with this $43,000 retained earnings into next year, fresh. All your revenues are zero, expenses are zero, dividend is zero, and you start fresh. So what goes to the next year? All your assets, all your liabilities, and all your equity, which is capital, stock, and retained earning. How much retained earning you have for next year? At January 1st, to start the new year, $43,000. Questions? Okay. One more time, I'm emphasizing how important it is to understand chapter 1, 2, and 3 perfectly, because then everything gets built based on that. So assuming as of this moment, you definitely know how to do journal entries, what's the normal balance for all accounts, what is asset account, what is liability account, what is equity account, how do you do adjusting entry, how do you prepare financial statements, and how you do closing entries at the end of each accounting period. Have a good day.
Thank you, Professor.